Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at Dropbox. So let's get started. Dropbox reported Q4 earnings on Thursday, and Friday the company was up over 20%. The company ended at $22.45, up about 19.96%. So we can see that earnings were good, and we're going to take a look at the today's episode and see what ended up happening with Dropbox and what were some of the major reasons this company is up. We're also going to take a look at the price of the stock and now see if I'm willing to invest at this price or if I think it might be too high or it might be a great time to enter. The first thing, one of the most important things that I keep hearing about is the company the board approved right here, $600 million of repurchase plan. And to me, that's actually a pretty big deal. And the reason it's such a big deal is, look, even with the company up 20%, this company only has a market cap of 9.32%. So a $600 million share buyback program, if they do buy back at this price right now where it went up 20%, the company's still buying back 6% of its total value, which I think it's actually pretty impressive. So let's take a look at how earnings did. So here we're on Seeking Alpha, one of my favorite websites that I like to use. Earnings per shares were $16, 16 cents, and these earnings per shares are non-GAAP. We're going to take a look at GAAP values in a bit, but earnings per share were 16 cents and it beat by 2 cents. Revenue was $446 million for the quarter and it beat by $2.6 million. It is actually, the earnings per share surprise beat was actually pretty good, but the revenue surprise beat of $2 million to a $446 million is not that big of a deal in my opinion. That's pretty flatline, but it's pretty good to see both beat in earnings per share and revenue. Next, what I like about Seeking Alpha is they give us forward PE ratio and forward price to sales ratio. The forward PE ratio for this company in December 2020, this company is expected to make 71 cents, which gives this company a forward PE ratio of 71 cents. On December of 2021, 2 years from now, this company is expected to make 84 cents. And usually I try to take a look at forward PE ratio for in the future 2 years, so for 2021. And this company has a forward PE ratio of 26.66. Based on the current price, right? That's estimating an earnings per share of 84 cents. For me personally, as just an investor, a 26.66 forward PE ratio is a little bit too high, especially depending on how the growth of revenue is, and we're going to take a look at. Normally for like the low double digits, I would be okay with like a 25 forward PE ratio. I would definitely like something below 20. So for me, a 26.66 is a little bit in the high side. If I was to start a position here, right now, this is the value where I'm a 26.66 forward PE ratio would be if I was truly really into the company, and I would most likely start a small intro position. I wouldn't go pretty big in the company. Again, that's just my decision, and for every investor, it's different. Next, we're going to take a look at this company's revenue. For next year, this company is expected to make $1.9 billion. We're going to take a look at what this company did for this year. This gives this forward PE ratio, a forward price to sales ratio of 4.9. For December 2021, a forward price to sales ratio of 4.39. So one good thing here we're seeing a decrease in forward PE ratio as time goes on, which means this company is expected to make more money. That's a good thing. And the second thing is we're also seeing a forward price to sales ratio decrease. That means this company is going to increase its revenue. And remember how I said that at 26.66, it's not a value I would definitely go into big. And that has mainly to do with the amount of revenue growth this company is doing. So I'm on Lazy FA, and in 2016, when compared to 2015, this company grew about 40% revenue. 2017 compared to 2016, this company grew 31%. And we can see here there is a decline in revenue growth. It's still a healthy double-digit growth, which is good. But for me to invest somewhere around like a 26, 27, somewhere around the 34 PE ratio, I'm looking more for like a constant 30% growth year after year. But now when we take a look at 2018 compared to 2017, there was also again a decrease in the amount of revenue growth, but it was still pretty high, 25% revenue growth. And now 2018 compared to 2019, this company grew about 19% revenue growth. Now, when we expect 2019 with the estimated value that we saw here in Seeking Alpha, which was 1.9, this gives a forward revenue growth of about 15%. So we can see year after year, this company's revenue growth is still pretty high, still in the high, and it's still in the nice double digits, but it is decreasing over time. As we see next year, this company is expected to only grow 15% compared to this year where it grew 19% and compared to last year when it grew 25%. So you can see that growth. And for that reason, to me, like a high forward PE ratio starts to look a little less enticing, right? If I was seeing a 25 constant 25% revenue growth, then I would be more inclined to this forward PE ratio. So that's what I have about the estimation of what I would go with this company. So at the moment, based on this information, just on the price valuation, I'm not a fan to go in right now. But if prices do go down, I definitely would go, especially because I see that revenue growth, that earnings per share growth, and based on the information that I collected here on what we're going to take a look at. So the first thing we're going to take a look at is this company's presentation that they provided for us during Q4. So in this presentation, we're pretty much just going to understand what this company is doing right now. And then the next presentation, the financial sheet, we're going to take a look at how this company is doing numerically wise and financial wise. So first thing, if you guys think about Dropbox, most people are still thinking about Dropbox as it used to be 10 years ago, right? It was more of like just a cloud storage place where you would just drop your items and that was it. Fortunately for shareholders, right? Fortunately for shareholders, that's not all Dropbox does today. So Dropbox today considers itself a software company, and it's investing in becoming a smart workspace area. And I think it's pretty smart to get into the workspace, because the American right now, the America enterprise and business is where all the money is definitely coming from. So right now they have 600 million registered users. They have about 550 billion pieces of content in their space being used from either emails strumming around or other types of extensions that they use, documents, files. Out of that 600 million plus registered users, 14.3 million of them are paying users. And out of those 14.3 million users, 80% of them are subscribers, and they use them for work. So you can see that the workplace is using Dropbox, and I think that's pretty impressive, right? Because if the workplace likes you, then you're definitely going to go far as business, right? We see Microsoft, right? Microsoft has Microsoft Office. The workplace loves that Microsoft Office, and we see Microsoft Office being a monopoly in most of these offices. We see a lot of Outlook, right? Skype, stuff, Adobe. All these are pretty much monopolies in the workplace, and this is the type of platform that Dropbox is getting into. And I'm going to explain how they're doing it. So I think this is pretty smart, right? Dropbox doesn't really create one product. What they end up doing is they have made an ecosystem, and in this ecosystem they allow all the other platforms, all the other devices and things that have already been made, being welcomed into this ecosystem. So for example, for productivity, they have integrations with Office, Adobe, G Suite, Outlook. No, that's Gmail, Outlook. And then, for example, communications, they have Slack, Workplace, Zoom, Team Microsoft. For enterprise apps, they have ecosystems with IBM, SAP, ADP, Oracle. So they have created this ecosystem. So they're pretty much the universe, right? They're universe, and each of these are countries or cities or anything inside this universe. And I think that's actually a pretty smart way to go around this business, right? Because all of these products right here that we see here are products that are used in the everyday here, especially in the enterprise business here in the United States, but I'm pretty sure outside of the United States, these are really wide known extensions and applications that are used. So I think it's pretty smart that instead of them creating something new to try to remove this, they're like, hey, let's try to create something where we are able to join all this stuff together and make it a very easy work experience for the workers. And that to me is pretty smart. So on this slide, this company, Dropbox, pretty much just has slideshows of different tools that they have, and they talk about all the integrations they have. They have HelloSign integrations. They have extension integrations with like Adobe, DocuSign, HelloSigns, with Gmail, with Outlook. Here they talk about how they're able to transfer files securely. They have deep integration partners with Google, Zoom, Microsoft, Adobe, and it's pretty good to see all these big names. Here they talk about how they have Slack integrations. They show screenshots of this. Zoom integrations. They show screenshots of this. So we can see, right, this company has I think it's really smart the way they're going with their company. And if you're thinking of them of just being that place where you store files, then you're definitely missing out on Dropbox. So next, what we're going to take a look at is this company's financials number. And like I said, this was for the fourth quarter and the full year of 2019. So for the fourth quarter, this company had $446 million of revenue, and that's up 19% compared to the same time last year. So quarter to quarter, we saw that 19%. And then if we take a look at 2019, like we saw in the previous website that I did, this company did $1.66 billion of revenue, which again was also up 19% year over year. I think that's pretty much a very funny coincidence. Net cash provided by operating activities was $186 million, which again, I think that it's always good to see a positive operating from cash flow from operating activities, right? Because that's where this company is showing that, hey, my everyday use makes money, and that's all you should really. I think that's one of the most important cash flows that I take a look at. At the end of the day, it also has a free cash flow of $161 million, which again, seeing a positive free cash flow is pretty good. For the end of the year of 2019, this company provided operation activities cash flow of about $528 million and a free cash flow of $392 million. So again, I think those are very good numbers compared to the amount of revenue comes, and again compared to the amount of market cap that this company has, right? A revenue of 1.6 billion. This company has a market cap of 9 billion. So that gives this like a forward a price to sales ratio of less than 5, like we saw, which I think is pretty good, right? There's definitely a strong case for the bulls here, a stronger case compared to the bears, in my opinion. If you're a bear in this stock, I would be more likely to vote for a bull than for a bear when choosing sides in this company. The board of directors, like we mentioned, authorized a Dropbox to repurchase $600 million of Class A shares. And like I said, right, I don't know why I'm thinking about Uber, but here Dropbox has become the world's first smart workspace. And again, I think that's important, right? It is a workspace. It's like I mentioned, it's a universe where it allows all these other smart applications for the work to enter this universe, and they are able to interact with each other. And I think that's actually a pretty smart thing that's happening with this company. Then here I've highlighted some of the fourth quarter fiscal 2019 results, the highlights they gave to us. So paying users ended at 14.3 million compared to 12.7 million same time last year. So we see again a growth. That's about a growth of a little bit over 10% growth. So you see that. And the average revenue per paying users right now is 125 compared to same time last year being 119 with 61 cents. So you're seeing growth in both paying users, and you're seeing a growth in the amount that they're paying. And that's a good thing, right? Because there's times when companies try to increase the amount of paying users, and by doing that they try to reduce prices just to entice more people to come in. So at the end of the day, they do get more users, but they end up getting a lower amount per user collected. And here they're not. They're seeing an increase in users, and they're also seeing an increase in the amount that they're paying. And then this is one thing I'm not a fan of. EBITDA, earnings before interest, tax, depreciation, and amortization. It's not a good thing to take a look at, right? A lot of tech companies are showing this, and that's usually their non-GAAP earnings. If we take a look at non-GAAP, it's most likely the earnings provided before interest, taxes, and all this. And all these tech companies are saying that, hey, this is the better result of what our company is actually doing. And most of the time it's because these companies are paying a lot of stock compensation to their CEOs and to their top dogs. And to me, right, at the end of the day, even though it's not how the actual company is doing, at the end of the day, it's still a cost, and it's something that still needs to be accounted for with how you're controlling that company. I do like, I understand where they're coming from, but at the end of the day, I really like to see that gap earnings and that gap margins. And even though there's still a loss, we're still gonna, if there's a decrease in that loss, or if things are looking better, then that to me gives me a positive reinforcement that, hey, this company is actually doing good because it's actually improving its margins. So next we're going to take a look at gap operating margins. So gap operating margins were a loss of 1.5%, and that was compared to a loss of 3.2% same time last year. So right, we're seeing an increase there. But now if we take a look at non-GAAP operating margins, non-GAAP operating margins are 15.6% this year compared to 11.0% last year. So if we take a look at that non-GAAP margin, at the end of the day, it shows, wow, this company has improved its margins by a lot. But I like I said, I'm not a fan of this non-GAAP things and these EBITDAs. But at the end of the day, this gap operating margin, again, it shows me, hey, from a loss of negative 3.2 last year to only negative 1.5 this year, it's showing me, hey, this company is actually improving. So even though it's a loss, it's still an improvement, which I think is something good to note. GAAP net loss for this company was $6.6 million. So this company lost $6.6 million this year compared to $9.5 million last year. And again, when we take a look at that non-GAAP net income, right now is sitting at 67.4 million positive compared to 42.3 million last year. And the true, like I mentioned, right, the previous earnings per share of 16 cents were non-GAAP. GAAP basic and diluted net earnings per share were a loss of 2 cents, opposed to that 16 cents we were shown earlier, and that was compared to a 2-cent loss similar same time last year. And now for the full year of 2019, there's pretty much nothing major that I really want to talk about. Total revenue was 1.6 million for the full year, and again, I mentioned that was up 19%. Average revenue paying per users this year, at the end of this year, was $123 compared to $117 last year. GAAP gross margins were 75% compared to 71.6% last year. Pretty good. Operating margins. Now this is really good. Operating margins was 4.8 loss compared to a 35% loss last year. And the GAAP net loss this year was 52.7 million loss was a 52.7 million loss this year compared to a $484 million loss last year. And we're going to take a look at where those losses came last year. Was pretty strong, and like I mentioned, it was based on that stock-based compensation. And that's something I hate, right? That stock-based compensation is not a huge thing I'm a fan of. So here, gross profit, we're taking a look at the company's income statement. And here, the first thing is revenue. We see, right, revenue for the 3 months of 18, we saw grew 19%, and for the year grew 19%. We're seeing a growth in gross profit. So gross profit was 341 million compared to 281 million same time last year. And the gross profit for the 12 months was even more impressive. Gross profit for 2019 was 1.2 billion compared to about 1 billion last year. Now what I wanted to see is, I wanted to see how this company is spending its money. Two things I like to see, especially with a software company. With the software company, things I think that are really help this company move forward are research and development, right? This company needs to start developing more stuff to be able to integrate its extensions with the other programs and have integrations with the other software. The second thing is sales and marketing. Like I said, most people, when they think about Dropbox, they still think of that platform where you only use for dropping files, but no, that's not the thing that Dropbox is. So I'd like them to see a healthy sales and marketing. So sales and marketing, and here I'm just going to take a look for the full year. Not doesn't matter about the quarter. In 2018, this company did $770 million on research and development. This year, this company did about $100 million less. I sometimes I'm not a fan of seeing a decrease in research and development. I personally, which I think is so weird, right? You definitely don't want to see a higher cost, but I would prefer seeing an increase. I want them to spend more money in research and development. But sometimes, right, it is understandable to see a decrease if they're just spending their money smarter. So seeing this, it's a decrease is something to take a note of, and it's something to see why there was a decrease, and that we'll have to take a look at their 10Q report. Sometimes they provide with some information on why that decrease happened. Sales and marketing are pretty much the same. Last year was 440 million. This year was 420 million. A 20 million difference is not that big of a deal in my opinion. Next, I want to see how much this company was paying in interest, because paying on interest definitely shows the amount they're paying in interest definitely shows if this company is heavily in debt. And here, right, last year they paid 7.1 million in interest. This year they paid 12.5 million in interest. Again, it's nothing compared to the amount of revenue that they bring into the table. So it's a decent number. It's not a heavy number. And here on net loss, last year this company lost about $1.35 loss on per stock. This year they have a loss of 13 cents. But we're gonna see, right, most of this company's loss comes from stock-based compensation, which I think is pretty dumb. I think the amount of how they're paying their CEOs nowadays is ridiculous. Next, let's take a look at weight average shares. Weight average shares last year, this company had 358 million shares, and here right now this company has 411 million shares. So we see an increase in diluted shares, but this company is trying to buy back about $600 million. So let's just check how many shares that would be. So this company can buy back 26 million shares. So that would definitely drop down. These shares by a nice amount. They'll be able to buy back about 26 million more shares. All right, so next I want to take a look at this company's balance sheet. And if you guys have been watching my channel, you guys know that the balance sheet is the favorite thing is my favorite balance document to take a look at. Cash and cash equivalents for last year was 520 million. Right now sitting at 50 million. So an increase of 30 million in cash and cash equivalents. It's not a big increase, but an increase is still nice to see. Next, in short-term investment, last year was 570. This year was 607. Again, another 30 million. So it's an extra 60 million in some form of quick cash compared to same time last year, which is a pretty healthy number. It's about a 5% when you add those two, which again, pretty healthy number. Total current assets at the end of this year were 1.24 billion, and last year was 1.21. So again, we see a small increase in total assets, about 30 million in total current assets. It's good to see an increase. The only thing is now when we take a look at liabilities, we don't want to see a heavy increase in liabilities. In actuality, we would like to see a decrease in liabilities. Next, if we take a look at total assets for this company grew by about $1 billion. But one thing that we have to take a note of is this year they're reporting an extra asset that they did not have to report last year. And this asset's about $650 million. So instead of that $1 billion increase, we'll do that 1 billion minus that 650, and that will give us about a 350 million increase in total assets. Just because we just want to take away this, but still a 350 million increase in total assets is pretty good. Another thing where we see a big growth is in goodwill. Goodwill grew by about $140 million. And what that means to me, if goodwill increased, that means that this company either must have purchased a small company in the past year, and that's why we see that increase in goodwill. So now we'll take a look at liabilities. First, let's just jump in straight to total liability growth. And look at this. Total liabilities grew by about 900 million. But just like in assets, this company grew, has a liability that they did not have last year, just because of the way reporting works. So that was a 700 million asset liability here. So in reality, this total liabilities only grew by about a little less than 200 million. So a 200 million growth in total liabilities, but we saw about a 350 million growth in total assets. So that's good that we see a stronger growth in assets compared to liabilities. Next, let's take a look. Let's just start from the beginning on how liabilities look for this company. The only one I really want to take a look at is deferred revenue. This company has higher deferred revenue this year compared to the same time last year, and this is just that the customers have paid Dropbox already for a service that Dropbox has yet to provide. Like we saw, this company now has subscription-based revenue, so this is usually coming from subscription-based, right? So a customer probably paid for 12 months, some 12-month subscription, but only like 5 months have gone so far. So that Dropbox still owes them about 7 months of services. So that's the only reason we see this deferred revenue going up, and that's the main reason we see that total current liabilities increasing. So when we take a look at the liability statement, it doesn't show me anything worried, right? To be honest though, their asset sheet was not that strong either. So the balance sheet, it's actually pretty balanced. It's a decent. It has decent assets and has decent liabilities. It doesn't have a strong enough assets that I'm willing to know that this company can just come out here and knock out their total liabilities. But it doesn't have a big total liabilities that I would be worried that this company is too overly leveraged at the moment. And finally, we're going to take a look at this company's cash flow from operating activities. And look, this is where I was talking about this company's stock-based compensation. This year, this company paid $260 million worth of stock-based compensation. And last year, this company paid $650 million. So that's about a $400 million decrease in stock-based compensation. So last year, they paid $400 million more stock-based compensation. And if we take a look at this company's net income, right, that we did, last year, this company had a net income of about $400 million, had a $400 million bigger loss last year compared to this year. And we see why that company had $400 million more loss last year than this year. And it's because of that stock-based compensation that we saw here. So that's another thing. I definitely like to see that the company's cash flow statement. It definitely shows you where the money is actually going. But at the end of the day, net cash flow provided by operating activities are increasing, and that to me is definitely a great thing. And that's it. That's all I have for Dropbox. So let's just do a quick recap of how I feel this company is doing. So first, just the way the company is doing from brand and the products. I think the products they have is actually a pretty smart way, and I think it's pretty smart on what they're developing. Like I said, that world, and they're just allowing other applications to come and live in their world, and they'll be able to communicate against each other, making this the smart workspace. I think that's actually a pretty good idea. If we take a look at forward PE ratio and forward valuation of this company, for my taste, like I said, it's all different between different investors. So if someone has some different opinions, feel free to post in the comments. I like to learn from other investors as well. But for me, for the forward PE ratio of 26 at the moment for 2021, I think it's a little high price for me based on that growth of revenue, right? We're seeing only for the next year, we're only seeing a 14% increase in revenue, even though for the past years we're seeing that revenue decrease. So I'm giving that forward PE ratio. It's not too overly priced for me at the moment, right? I wouldn't say it's dramatically overpriced, but it's not something I would definitely go in heavy in. If I do see a decrease in price for this company, it's something I would definitely go in. Next, let's talk about we talked about the revenue. Let's take a look at this company's balance sheet, right? This company has, again, it doesn't have I wouldn't say a strong balance sheet. It has a decent balance sheet, and it has a decent assets, and has decent liabilities. I think it's pretty balanced asset and liabilities. There's no one of them keeping a heavier lift than the other one, which I think is good, right? I definitely would not like to see liabilities stronger than assets. Assets I would give a little bit more strength, but liabilities is just right there next to it. Next, what else do we have to talk? In the cash flow statement, we see this company pays a huge amount of stock-based compensation, which is something I'm not a big fan of. And we see that's the main reason this company has a net loss in net income. And I can see why this company reports non-GAAP earnings, prefers to report non-GAAP earnings, where they take away that expense. But again, at the end of the day, that's still an expense that one should definitely keep in mind of and keep a note of. So that's it. I hope you guys enjoyed this episode on Dropbox. Let me know what you guys think. Have a good night and see you next time. Don't forget to hit that subscribe button either, and don't forget to share. So take care, guys. Peace.